Money Matters. My name is Jim Butler with Marcum Wealth, and my partner in crime today is Mike Dever of Brandywine Asset Management. Hello, Michael.
Hello there, Jim. How you doing?
Good. How are you?
Doing great, thanks.
Good. Well, let's dive right into it. We have a great guest that is waiting in the background, and before we pull him in, why don't we talk a little bit about some current events, knowing that we don't want to date ourselves, but 2024 is a special year, as we know. And instead of diving down a rabbit hole, such as what impact will the elections have on the market, I say very little. And again, not opening that chapter, but I think looking more long term, some aspects that we can consider that we share with clients is, in the short term, the market is going to be a bit of a roller coaster. Some years a little bit more crazy than others, and who knows how things are going to end up this year. But let me ask you, to what extent you've heard any common questions, from clients, from colleagues, with regards to any concerns about market activity so far this year?
Well, we've had more recently some wild activity with that meltdown in Japan a month and a half ago. They were down double digits in one day, the worst since 1987. And of course, there's just a lot of angst around the election.
Right.
I think, and as much as I think it doesn't, we'll see what happens long term. But in the short term, I do think there's a lot of opportunity for the election to cause some disruptions, because I think there's some opportunities or some incentives, for example, with the funding, government funding that's coming up again, that I don't think the Republicans want to see it happen. For them, if the market melts down and there's a lot of crisis of confidence in the U.S. and in the U.S. dollar and financing prior to the election, they would welcome that. And so I think they're going to play hardball with negotiations. Right now, the negotiations they're looking for some changes in the voting requirements, looking for confirmation of citizenship. Democrats are strong against that, and I'm not sure we're going to get a settlement out of that before they need to, which could, coupled with what we're seeing already with a little top-heavy market action, could lead into a pretty weak period potentially. Long term, I think it's, you want to be with the United States, you want to build on corporate growth and ride with it, but I feel a little nervous about it in the short term.
So are there any specific opportunities that clients can take advantage of short term, or are you suggesting they not do that?
So there's always something that's an opportunity, I guess, and there's always something you can do. It just doesn't, whether people do it at the right time or not. Most people react and do it at the wrong time, of course. But I do think we're starting to see a turnover between large cap growth and value and smaller caps. And so I where we've had this huge disparity over the last decade with large caps, growth stocks especially, continue to get bigger to where now you got a handful of these $3 trillion valuation companies, which is just nobody who would have thought of that, a few years back even. And a lot of the smaller companies and the value companies, they haven't really moved much at all. Mm-hmm. I do think we have a real good opportunity of seeing that style shift and money coming out of some of the large cap growth stocks and going into some of the smaller cap value stocks.
Well, what's interesting is as I'm listening to you, what I think of is the benefits of having a diversified portfolio, because our approach is to really help clients focus on their goals, short term and longer term. And then because we take a planning approach to understand how they can best reach those goals, that spans many years, and at least their generation, if not beyond that. So what I think of as you're suggesting, a move away from really a growth-oriented strategy, to be diversified. And what we suggest, not saying it's right, it's just a way to temper downside volatility, and that is, to take advantage of value, take advantage of smaller companies, larger companies.
Yeah.
Bit of international exposure, probably more in developed countries versus developing countries. For those that don't have the risk appetite, for example. So one of the things I also think of is, the chart that shows how major asset classes have performed over longer periods of time. And at least through the first half of this year, 2024, U.S. large caps have outperformed again. And right behind them are small caps, but, there's still quite a bit of disparity between the two. So large caps were up 16% as measured by the S&P. Small caps up about 12%. And
that's all from 2 months ago.
What's it?
Up until 2 months ago, small caps were dramatically trailing. Then you had 1 month where it switched a little. It's actually switched pretty dramatically 2 months ago for 1 month, and then it kind of got back again. But that's one of the better performances the small caps have had relative to the large caps, and it's still trailing.
So it's interesting, Mike, as we're touching on it, maybe I'll just say overweight small caps in January, you might not have been all that excited. But with some patience, as you're pointing out, as we've moved into the year, it's paid off, much more handsomely.
Yeah, I think it points out the value, and I don't want to underplay, the value of having an advisor versus, and I'm not doing this to sell you. I'm just saying that people, and I wrote my book about this, Jackass Investing. People will do exactly the wrong thing at the wrong time, and that's just their human nature. It's what you do. And if you've had a long run where large cap growth has been outperforming, people probably have their portfolios heavily weighted, even if they didn't intend to, just because those stocks have run up so much more than the smaller cap value stocks. Their portfolio, and combined with the fact that psychologically probably been adding money in that side, but they end up with a really, really unbalanced portfolio that's heavily skewed towards large cap growth stocks rather than being balanced. And so being with someone who can continue to guide them to taking the balanced approach over time, even when you might go a couple of years where you're not keeping up with NVIDIA, you're not keeping up with Microsoft or Apple or Amazon, it's still the long-term best approach for people to take.
Well, what I think of is, sometimes what's wrong with the 60-40 portfolio. I'm not saying the 60 portfolio is the answer for, every investor, but it's that diversified approach, and it, allows for growth participation as well as some temperance on the downside. Mike, let's move to our question, if we could. And Henry Galley in Philadelphia is asking the question: what is the function of a miner in the crypto world?
Okay, so Henry, it's a great question, and crypto is confusing on so many levels for so many people. I'll just talk about Bitcoin because that's where miners really play a role. When Bitcoin was started 15 years ago now, you actually, to get a new Bitcoin, you go through a process that's called mining, where people actually run algorithms on their computer. After they solve this problem, this algorithm, they get a batch of Bitcoin. It started out they would get 50 of them. And then they have halvings every 210,000 of these blocks that get solved. And so in the next halving, it was 25, and then 12 and a half, and 6 and a quarter. And now it's 3.125. Every time one of these blocks is solved, this algorithm on a computer says, hey, I got the right answer. Boom, whoever that was that did that gets awarded 3.125 Bitcoin now. So now we're close to 20 million Bitcoins totally mined in this process, out of 21 million that is total. But it's going to take another century to get to the million done, just because these halvings keep happening. and they'll end up with getting very few Bitcoins in the end of this. But it's essentially replicating the process of mining for gold. I think that's the mentality of using that nomenclature.
Well, good answer, and we could take that in a direction all itself, because that really opens the question with regards to investing in crypto as part of a portfolio. And the short answer might be, for some people yes, for other people no, and there is no one right answer.
It's clearly a wild card.
Yeah. So if you have a question that you would like one of our panelists to address, please send it in, and here's how you can do that.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our hosts and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Well, here we go, and let's welcome in our guest for the show. Michael, let's give a warm welcome to Sean Saari of Marcum LLP. Welcome, Sean.
Hello, Sean.
Hey, guys. Thanks for having me. Appreciate it.
So, Sean, I'll give a brief introduction, and that is you are a partner based out of the Cleveland office in the advisory group, specializing in valuation, litigation support. But why don't you take a minute or so and just share with us more specifics in terms of what you get involved in?
Sure. So I'm a partner in Marcum's Valuation and Litigation Advisory Group. And really what that means is we help people primarily value privately held ownership interests. And very frequently we'll get involved in litigation matters where there's some sort of financial component, whether that's the value of an ownership interest or it's some sort of economic damages. So about half of my time is spent in each of those worlds. And on the valuation side, there are a whole host of reasons that we'll end up valuing ownership interests in privately held companies. There are strategic planning purposes, there are financial reporting purposes, there are dispute-related purposes, and then there are tax-related purposes, which I want to spend a little bit of time talking about today, and how gift tax and estate tax can come into play when individuals have ownership interests in privately held companies, and how valuation fits into that piece of the puzzle.
How long does it take when you look at from beginning to end, a privately held company comes to you, a client, and asks for a valuation for whatever purpose they might have? About how long does that take? Is that a year? Is it 3 months or what?
It's a great question. And I think there are some misconceptions around this sometimes, because I think some folks come to us and think, hey, this is something you guys can turn around in 24 hours. They're used to being able to, click a button and get an answer. And, there are other folks who come in with different expectations. But I would tell you the standard valuation typically lasts somewhere between 4 to 6 weeks. And that's a combination of making initial document requests and then getting that information from our client. It involves a management interview process where once we start developing our exhibits and valuation report, that we would want to have a conversation with the key people at the company to go through questions we may have, because the numbers don't tell the whole story. We want to get the background of the business as well and try to identify what sort of adjustments might be necessary. And then after that step, typically we can wrap up a draft, share that with the client, get any feedback that they may have, adjust as appropriate, and then wrap things up. So we've had engagements so that we can turn around as quickly as a week or two, depending on the scope. And frankly, we've had projects that have lasted years, just depending on the situation. Those tend to be more litigation related, where they just drag out depending on the pace of that dispute. But it's not uncommon for certain cases like that to last a pretty long time.
When you're talking about the valuations, and I guess that's for preparing to either gift or somebody's going to inherit, a privately held company, for example. Who's paying that tax?
That's actually another great question, because it's one that we get very frequently, and I think there can be some confusion around it as far as who's responsible if there is gift or estate tax to foot that bill. And in the scenario of an individual making a gift very frequently to a family member, those gifts are sometimes taxable, and depending on the amount of gifts that individual has made over time. And right now, that limit is in the $13 million range, 13.61 million in total over their lifetime through 2024. Someone can gift before any sort of gift tax kicks in. But when it does kick in, that gift tax is actually owed by the person making the gift, not the person receiving the gift. And I think very frequently individuals are concerned, I'm receiving a gift, how much tax am I going to owe? When really that's the responsibility of the individual who's making the gift.
Great.
But Sean, wouldn't that potentially have an effect on how much is actually gifted? So, using a $10 million number of privately held stock, if 20% gift tax applies, I'm just picking a number, of course, then the net would be $8 million. Would the person gifting take that in consideration or not?
So it would be something that the person making the gift would want to take into account, because when they are making that gift, if it is a taxable gift, they're going to need to make sure that they've got money set aside in order to pay that tax. So to the extent that, if there's 10 million of value that is available to transfer, it may make sense in that sort of scenario that, it might be 6 or 7 million that is ultimately transferred, so that there's some value left over in the hands of the donor that they can use to pay that tax that will be owed on that gift.
Right.
What's the difference between gift tax and estate tax?
So they're interrelated from the standpoint of there's a lifetime threshold that individuals can transfer, whether it's during their life via gift, or it's at the time of death and it's transferring from them to their beneficiaries. So right now, again, that total per individual is 13.6 million that someone can transfer over the course of their lifetime. And if they were to pass away in 2024, that's the total amount that can be transferred prior to gift tax or estate tax kicking in. So if we had a scenario where someone had gifted 10 million through 2024 and they pass away that year, there's another 3.6 million, if there are sufficient assets in the estate, that could be transferred to the next generation before any sort of estate tax would kick in on whatever amount might be in excess of that 3.6 million.
Sean, how do you address the unknown, which it is at the end of 2025, the exemption equivalent goes back to previous levels, which I believe is the $6 million range. Do I have that number right?
Yeah, it's going to be in that ballpark. It's going to be 6, maybe 7 million. It's an inflation adjusted number. And I mean, that's one of the challenges that we're working with now from a planning standpoint, where when the TCJA came into play, it set increasing thresholds for what was able to be gifted or transferred upon death before gift or estate tax would kick in. So right now we're at 13.6 million. That number is going to increase for inflation in 2025. And at the end of 2025, if there is no further legislation, that threshold is going to be reduced significantly down to what would have been 5 million adjusted for inflation. So right now that thought is it's going to be around 7 million if we get to 1/1/2026, and there isn't any further legislation on either extending or adjusting what that future gift and estate threshold will be. So that's really one of the kind of prime planning considerations right now, is kind of being prepared to the extent possible that if an estate or an individual has assets certainly in excess of that $7 million threshold that we're thinking right now might be the new norm going forward, it may very much make sense to transfer some of that value prior to the end of 2025, because if we get to that point, things don't change and that threshold reverts, there will be tax on anything that's transferred above that $7 million amount, whereas if it had been transferred out in 2025, there's no clawback. So if we're able to get that money out when that threshold is higher, the IRS isn't going to come back and say, well, we've changed the threshold now, and because it's lower, you're going to owe tax. It's kind of this safe haven. So, the thinking right now is we want to be prepared to transfer value prior to the end of 2025 in case that threshold does revert back to that lower number, because there are very real dollars to be saved in estate tax and gift tax if those transfers are made prior to that change.
But could the business owner be concerned about losing control if they gift prematurely or before, as you're saying, 1/1/26, and they say, but I'm going to lose control if I do that?
It's one of the major concerns, and I guess there are a couple ways to address that. Number one is, from just a financial planning standpoint, an owner doesn't want to give so much away that it's going to put them in a position that they're not going to be able to execute on their financial plan. So while it may be advantageous from a tax perspective to transfer the wealth, they may want or need those assets for personal purposes. So there's the personal aspect of this as far as, well, how much can or should I transfer without putting myself in a situation where I'm not going to have what I need in order to get by. So it's important to keep in mind, the bigger picture in all of this as well, that can certainly be a very significant tax benefit to move those assets, but there's more to life than saving on taxes as well. But certainly when we get to the sort of dollars that we're talking about, there's typically sufficient assets to be able to live on and still be able to make some of those gifts and take advantage of that potentially changing exemption.
Is there a way to reduce the value of what's going to be gifted or left in the estate, I guess? And I know one of the things that I heard about was with a GRAT, that potentially you can end up allocating more, distributing more as a gift, but not have it run over the threshold because it's at a lower valuation. How's that?
Yeah, so I think there are really two different concepts that can come into play there. So one is just the fact that for privately held ownership interests, there can be discounts that can come into play for things like lack of control and lack of marketability. And those discounts can be fairly significant, and we can be talking upwards in the 30 to 40% range, where the value of that ownership interest that's being gifted or part of the estate may not just be the pro rata share of the overall value. And that as a minority owner in a privately held business, you're kind of really along for the ride. You can't force a liquidity event and convert that ownership interest into cash. And because of that, these discounts are very real and very appropriate to consider. So just that fact alone can help transfer value in a more efficient manner, where although the overall value of that slice of the pie might be $5 million, when we take into account the discounts, it might be something closer to $3 million. So we can get that out with using less of the exemption. Another thing that could come into play, and this gets to your earlier comment as well, Jim, as far as control considerations, is that if a non-voting interest is set up within the company and that non-voting interest is transferred, there can be some additional discounts that can come into play there, and can also help alleviate some of those control concerns as well, where the individual who currently has the ownership interest can retain control but still transfer some of the economics and the value to that next generation. And then when it comes to the GRAT, typically where we've seen that from a valuation standpoint is GRATs being created where there's an ownership interest that's transferred, and that transfer is paid for, if you will, by income or distributions that the GRAT receives from that interest, and it's used to pay back really the transfer of that value. So there are ways that we've seen GRATs set up, and one of the common concepts is just called laddering, where it may be done year after year, where a GRAT is set up, an ownership interest is transferred, and it's really then paid for via a note with the income from that ownership interest. And if it's set up and it's an appreciating asset that is throwing off some income, it can be a great way to transfer value because it actually ends up not using any of that exemption, but allows for the appreciation from that point forward to be moved outside of the estate. So, grats are, I would say, probably a step further as far as kind of advanced planning techniques, but can be an incredibly useful tool to help transfer value out of an estate without utilizing or eating up any of that exemption.
Sean, maybe for those that don't have a complete understanding, can you give a big picture description of what a GRAT is?
Sure. So it's a grant or retained annuity trust, and really I would view it as, kind of in simple terms, an estate planning tool that allows, if used in a way of, as we've seen very frequently, allows for an interest to be transferred from an individual to a trust on behalf of some beneficiary, and basically allow for the income from the asset that's put into that trust, very often a privately held ownership interest, to basically pay for the value of what was transferred into the trust to fund it in the first place. And by paying back, what effectively was that transfer, there's really no gift then. And it allows that transfer to escape being part of what will be considered for gift tax purposes. So for individuals with significant wealth who either don't want to use up their exemption now or have fully maximized and utilized whatever their exemption might be, that's a way that some value can still potentially be transferred, and take advantage of appreciation in certain assets and getting that out of the estate.
And receive an income as a result.
Exactly.
Does the money that gets transferred, and you're talking about it being, whether it's a GRAT or just a direct gift over, could you discount it further? You talk about maybe 30 or 40% by having a share class that does not allow for distributions of profits in that group, but they still have some sort of an ownership right?
So that's a great question. It's actually something that I don't know if we've come across before. Not that it couldn't be done, but typically, as an owner in the business, that interest would be entitled to distributions if they are made. So what we will more frequently see is something where there may be a non-voting class that's set up, so that kind of puts that owner at a disadvantage, which allows for potentially a larger discount for valuation purposes. And it may just be in an entity where we just don't have distributions that are planned in the near term. If we've got an entity that is making regular distributions, I would expect that entity would probably have a higher value and lower discounts than that same entity, all else being equal, not making distributions.
Thank you for listening. Thank you to Sean and Mike. Really appreciate the conversation. Tune in to our next show, which is Chad Zaretic, who's a partner at Araminino LLP, an accounting and consulting firm. And until then, thank you for tuning in.